love the channel and find it useful in becoming a happy retiree. Subscribe today. A ton to talk about that impacts you, and anywhere from the big macro environment, things are great from an earnings perspective, and as Louis C.K. said, everything's great, but nobody is happy. Or at least he said something like that. Today I want to talk about, typically, I love talking about the big picture, so the macro picture, and that's partially because I studied in economics. I probably liked the most macroeconomics, and still, if I were to have to be pegged down on one particular way that I look at the economy in the world, I would say macroeconomics is still a huge part of what I do and our team does, and I love it, one. But every so often, we will kind of zoom in instead of zooming out. And I think sometimes I do that just because it gives some of the examples you can give when you zoom in on a particular company or a particular sector, it really paints a much clearer picture of the broad perspective. And when we go through a market like we've been through in 2018, which is kind of a frustrating market, every time we get any sort of momentum, the steam kind of comes out of this market. Even when we get great news, and we have had phenomenal news over the last couple of weeks here, about, let's call it a third of the S&P 500 is reported earnings already for the first quarter, and the results are just fantastic. I mean, earnings are growing 18% year over year from last year. Compare that to periods of time when we've had good earnings seasons that are 4 to 5% higher over the last year. Yes, tax reform is going into that number. Part of the reason companies have so much more net cash is because of tax reform, and that it gets kind of baked into the numbers. But when you have companies and their bottom lines, what they're taking home after taxes and everything is up almost 20% from the year prior, that's one of the strongest earnings seasons you will ever see in markets, period. Net profit margins, 11% higher than this time last year. That's the highest we've seen since before the Great Recession. So companies have just continued to beat earnings. There's tons of examples this week. Caterpillar, United Technologies, Verizon, 3M, Alphabet, Google's parent Alphabet, all anywhere from on the low end, they've been good, all the way to great. Yet prices, for the most part, have been negative. 3M down 10% for the week. Caterpillar down 5% for the week. Google down 4%. So even though you've seen these companies do as well or better than they've ever done, some of these are all-time highs as far as profits are concerned. They're raising dividends. The market has said, look, we're still not satisfied. Now, S&P 500, to be fair, wasn't a terrible week. It was basically flat, down just a fraction of a percent. The Dow down about 0.6%. So no matter what is happening, markets are still saying, hey, just give me more. It's not good enough. Part of that can be tied back to interest rates going up. And we saw interest rates this week finally crack that 3% number on the 10-year Treasury. So that, to some extent, that's creating this short-term indigestion. Hey, wait a minute, if rates go up, that means the economy slows down. So maybe even though we've gotten these great earnings, maybe it means that we slow down from here because the market is forward-looking. It's out 6 months from here. Doesn't matter what had just happened. Doesn't matter that we're talking about quarter one in the rearview mirror. We worry about quarter three and quarter four for stocks. So you put all that together, and there's still some uneasiness with markets. And I want to zoom in on a couple of areas today. One is a particular company that I think tells a really interesting story about what typically happens when companies fall, when their underlying business is still really, really healthy, but their stock price hasn't done well. And we're gonna talk about some of the metrics around Procter & Gamble today as a really good example. You zoom in on one company, how can you find some value in an otherwise market that doesn't seem to be rewarding the broad indices? And then I want to talk about the energy sector, which has had one of the largest disconnects that we have seen in 20 years, and what that potentially means for that sector of the economy, and what that means for you, or how you could potentially take advantage of that as an investor. Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.